Happy Saturday, everyone. It's February 14th, 2026. So whether you're out on the slopes for Valentine's Day or, just enjoying a coffee, we have a huge deep dive for you today.
We certainly do.
We're heading up to the mountains. We're going to take a really hard look at the Mammoth Lakes real estate market. And I want to say this right at the top. If you've been following the market for the last, 3 or 4 years, you're probably used to hearing words like frenzy, bidding wars.
Panic. Yeah, that was definitely the soundtrack of the whole post-pandemic era.
Exactly. But looking at the 2025 year-end summary and the first chunk of data from this year, 2026, that soundtrack has, it's just stopped.
The music is off?
The vibe isn't a mosh pit. It's quiet. And for some people, maybe a little too quiet. The whole market feels like it's shifted from just chaotic to, I'd say, calculated.
That is the perfect word for it. Calculated. I mean, we've got a ton of data to get through, but the headline here, it isn't a crash, and it's definitely not a boom.
It's something in the middle.
It's a return to reality. The headline is that the easy money era is over. We are now in the era of strategic positioning.
Okay, so that's our mission for today. Let's unpack what strategic actually looks like on the ground. We have to get into the numbers.
Oh, yeah.
Because some of these condo stats look on the surface absolutely wild. We need to explain why they're kind of misleading.
A huge asterisk there.
And we need to talk about what I'm calling the luxury trap, which seems to be developing at the high end. And, of course, the big one. The wild card that's killing deals right at the finish line.
Property insurance. It's a huge one. It might be the single biggest point of friction in the market right now.
So let's start with that big picture. 2025 is in the books. How does that set the stage for where we are now in early 2026? What's the core narrative?
I think the core narrative is that Mammoth Lakes has matured. If you think back to the frenzy of 2021, 2022, that was all driven by, cheap debt and this desperate emotional need for a lifestyle change. That energy has completely dissipated. What we saw in 2025 was a thoughtful market. The report calls it normalized, but I think thoughtful is better because it implies real intent.
Thoughtful implies that people are actually using their brains, not just, their adrenaline.
Exactly. For buyers, it meant they finally had options. They stopped compromising. In the boom years, you'd buy pretty much anything with a roof and a heater.
Oh, yeah.
Now, buyers are taking their time. They're scrutinizing the details. And for sellers, you could still get a great result, but only, and this is a big only, if you were realistic. The days of sticking a sign in a snowbank and getting 5 offers by lunch, they're just gone.
But here's the thing that surprised me. When demand softens like that, you usually expect prices to just crater a fire sale. But the report is clear. This was not a declining market in terms of value. So why didn't prices fall off a cliff?
It really comes down to who owns the property in Mammoth. It's the leverage profile. The vast majority of sellers are not over-leveraged.
They have a ton of equity.
A ton of equity, or they own it outright. So when the market cooled off, they didn't panic. They didn't have to sell. They could just sit tight.
So it's basically a standoff.
It is a classic stare down. You have sellers who are remembering the prices from 2023, and you have buyers who are living in the reality of 2026. The result isn't a crash. It's just slowness, friction.
And for anyone listening who's thinking about buying, I think that's a key takeaway. You're not walking into a foreclosure crisis.
Not at all.
You're not going to steal a house for pennies on the dollar. You're walking into a negotiation with someone who can probably afford to wait you out.
That is a very dangerous assumption to make, that a slow market means a desperate seller. In this market, slow just means patient.
Okay, let's get into the gears of it all, because this is where the data gets a little tricky. Let's talk condos. In Mammoth, condos are the engine.
Well, they're the absolute bread and butter, the vast majority of all the transactions.
So I'm looking at the raw stats for condos in 2025. And if I just skimmed this summary, I'd think we were in the middle of a massive explosion.
Right.
I mean, listen to this. Total sales, 275 units. That's up 13% from 2024. The median sale price hit $825,000. That's a 14% jump.
Big numbers.
And the total dollar volume, nearly $299 million. That's a 38% increase over the previous year.
If you only looked at those 3 numbers, you'd be popping champagne, thinking the boom was back.
Right, a 38% jump in volume. That sounds like a market on fire. But you flagged this for me right away. There is a huge asterisk here. What is going on?
The distortion is all coming from one place, new construction.
Yeah.
We had some major luxury developments, projects like the Creek House units that finally closed in 2025.
Okay.
But you have to understand the timeline. Buyers signed contracts on those units maybe 12, 18, even 24 months ago. They were locked into those prices long before 2025 even started.
So the decision to buy happened way in the past, but the actual data just hit the books last year.
Precisely. And these were not your typical one-bedroom ski condos, these units. They had an average purchase price of over $2.9 million.
So I like to think of it like a swimming pool. You have a bunch of normal swimmers, and then a whale jumps in.
Right.
The water level rises, for sure, but it's not because everyone else got bigger. It's just the whale.
I love that analogy. So that whale, that $2.9 million average for the new stuff, it drags the overall median way up to $825,000.
So if we kick the whale out of the pool for a second, what does the real story look like for the average existing condo?
The real story is much more sober. If you look at price per square foot, which is the true equalizer, the value actually decreased by 3.5%. The market really settled around $675 per square foot.
That is a huge distinction. So the sticker price went up because the things being sold were brand new and huge, but the actual value you get for your dollar per square foot went down.
Correct. And that lines up perfectly with the days on market data. It's taking about 110 days to sell an active listing. And even the ones that did close took 71 days on average.
Which is flat compared to 2024.
Exactly the same. So despite that flashy 38% volume number on paper, the street-level reality is that things are moving pretty slowly.
Let's talk about inventory. If it's taking almost 4 months to sell something, are we seeing a big pileup of listings?
We saw a pretty normal seasonal peak.
Yeah.
Inventory got up to about 115 listings midsummer, which is typical. And then it settled down to about 90 active units by the end of the year. We're seeing about 21 closings a month.
So 90 units, 20-ish sales. That's what, 4.5 months of supply?
Which is the textbook definition of a balanced market. It's not a buyer's market where you have all the power, and it's not a seller's market where you have to, waive everything. It's just neutral.
But within that neutral market, the report talks about a flight to quality. Is that the other side of the new construction coin?
Absolutely. The new stuff sold because it was perfect, turnkey. And buyers in 2026 are incredibly picky. If you have a unit that's updated, it's staged, it looks like it's out of a magazine, it sells.
But if it has that 1980s shag carpet?
You are in trouble. If it smells like old fondue and has dated everything, buyers don't want a project. They want to drop their bags and go ski.
Yeah, they don't want to spend their weekends managing a contractor.
Exactly. So that spread between the grade A listings and the grade B listings has widened significantly. If your unit is dated and you price it aggressively, you're just going to be chasing the market down with price cuts for months.
Okay, let's pivot to single-family homes. Because if the condo market was distorted by all that high-end inventory, the single-family market looks, well, almost eerily flat.
It is remarkably consistent. It really is like someone just hit the pause button.
The numbers are almost identical to 2024. Total sales, 63. That is the exact same number as the year before. Median price, 1.3 million, also consistent. It's just flatlining.
But again, flat can be deceptive. While the sales count was flat, the underlying value actually shifted in the opposite direction of condos. Remember how condo price per square foot went down?
Right, it dropped 3.5%.
Well, for single-family homes, the price per square foot increased by 7.6%. It's up to about $637.
That feels contradictory. Why would the value of condos drop while the value of homes is rising?
It's all about scarcity. You can always build more condos. We just saw that. You can go vertical. But you can't easily create more single-family lots in a place like Mammoth.
The land is constrained.
Totally. You're buying privacy, you're buying dirt, and you're buying that scarcity. And so people are willing to pay a premium for that, even if the total number of sales is really low.
But there is a cost to getting that premium. You mentioned days on market. Is it taking longer for sellers to get that higher price?
Much longer. To get that higher price per square foot, sellers are really enduring a waiting game. The days on market for the homes that closed jumped 19%, up to 87 days.
So nearly 3 months on average, just to get a contract.
And that's the average, which means a lot of them are sitting for 6 months, 9 months, or more. The inventory is incredibly tight, only about 20 active listings at any time, with maybe 5 or 6 selling per month. It's a velvet rope market.
Wow.
Very few getting in, very few getting out.
So only 5 or 6 homes are selling a month. You really have to be the chosen one to get a deal done. What's the common thread for the homes that actually do sell?
The report calls them the Goldilocks homes.
Yeah.
They have to be just right. Buyers are demanding garage space, which is obviously essential in the winter.
A must.
They want good natural light. And there's a huge premium right now on anything with ADU potential. An accessory dwelling unit.
Ah, the rental income angle.
Well,
Or, you know, just a place to stick the in-laws so you don't have to share a bathroom.
Exactly. That flexibility is incredibly valuable. So if a home has those features and it's been updated, it moves. If it's a dark or garageless cabin from the 70s asking $1.5 million, it is going to sit. And sit for a long, long time.
This brings us to what I think is the most actionable part of this whole analysis. The report calls it a tale of two markets.
This is critical.
We talk about the market like it's one thing, but the leverage, the power, it shifts dramatically depending on what your price point is.
It really does. You can't just ask, how's the market? You have to ask, how's the market for my specific price bracket? And the best way to see that is months of supply.
Okay, break it down for us. Okay.
Condos, like we said, are as 4 to 5 months of supply. Neutral territory. Single-family homes under $2 million, that is actually quite tight, only about 2 months of supply.
So if I'm looking for a, quote, starter home in Mammoth, and I know calling a $1.5 million house a starter home is crazy, but that's the market?
It is.
I'm actually in a seller's market.
Yes. As a seller there, you have very little competition because there is almost nothing for sale.
Yeah.
But the moment you cross that $2 million threshold, the floor just drops out.
What's the number for luxury homes over $2 million?
We are looking at 12 months of supply.
Wow. A full year.
A full year. If not a single new house came on the market starting today, it would take a full year to sell off the current inventory. That is a massive buyer's market.
That completely flips the entire negotiation. If I'm a buyer looking at a $2.5 million home, I am holding all the cards.
You're holding the whole deck. You can ask for repairs, you can ask for credits, you can take weeks to decide. But if you're a seller in that bracket, you have to wake up. You are competing for a tiny, tiny pool of buyers. If you are not priced perfectly and in the top 10% of presentation, you might be on the market for 2 years, not 2 months.
That's that luxury trap I mentioned.
Yeah.
If you have carrying cost taxes, insurance, snow removal, holding that property for 2 years is just a wealth destroyer.
It absolutely is.
Yeah.
And that leads us right into the financial reality of all this. We have to talk money. So today, Valentine's Day 2026, where are interest rates?
The report shows things have really stabilized. We're not back in the glory days of 3%, and we probably never will be. But the volatility seems to have calmed down. The conforming 30-year fixed is sitting right at 6.04%. Jumbo loans are a bit higher, 6.27.
So we're in the low sixes. And while that still sounds high compared to 2021, the market has kind of digested it. The report calls it the stabilization effect. Buyers feel confident that rates aren't going to shoot up to 8% tomorrow.
It's predictable.
That predictability lets them pull the trigger. It's not stimulating the market, but it's no longer freezing it solid.
However, there is a new freeze factor. And it isn't the bank, it's the insurance company.
This is the wild card. And I cannot stress this enough. The report explicitly lists property insurance availability as a primary threat to mountain real estate.
We've heard some horror stories about cancellations. Is it actually getting worse?
It's getting more complex. It's not just about the price anymore, though premiums are hiking huge amounts, sometimes doubling, tripling.
Wow.
It's about availability. Can you even get it? Especially for older condo complexes. If a whole complex gets dropped by its master carrier because of wildfire risk, finding a replacement policy is a nightmare. And that cost gets passed directly to the owners.
We're talking thousands of dollars a month in unexpected costs.
Easily. We're seeing deals fall apart at the 11th hour because the buyer just couldn't secure fire insurance, or the quote came in so high it just blew up their debt-to-income ratio.
So the days of, calling your agent the day before closing, getting a policy in 15 minutes, those are over.
Long gone. If you're buying in Mammoth in 2026, the insurance broker is your first call, not your last. You have to know if the property is even insurable before you fall in love with the view. If you skip that step, you are setting yourself up for major heartbreak.
That is a very sobering reality check. Okay, so let's look forward. We have the roadmap. If I'm entering this market now for the rest of this year, what are the new rules of engagement?
The forecast is for more of the same, balanced and deliberate. Inventory will likely follow that normal seasonal pattern. It'll rise in summer, dip in winter. Rates might ease a little bit, but don't bet the farm on a big refi boom.
Okay, so if I'm a buyer, what's my play?
Patience is your weapon. Seriously, don't just look at the just listed page, look at the 90 days on market page. That's where you'll find the motivated sellers. That is where you have the power to negotiate a deal below the asking price. You have time. You should use it.
And for the sellers.
You need to banish the word aspirational from your vocabulary. You just cannot price your home based on what your neighbor got at the peak of 2022.
That world is gone.
It's gone. You have to price for the market that exists today. And you have to spend the money on prep, the staging, the paint, the minor repairs. Like we said, that gap between turnkey and fixer is a canyon right now. If you don't do the work, the market will punish you severely on price.
It really does sound like the market has, well, it's matured, it's grown up, the speculators are gone, and now it's just real estate.
That is the perfect summary. It's a sustainable rhythm. The people who are buying in 2026 are buying because they truly love Mammoth. They love the lifestyle. They aren't trying to flip a condo in 6 months for a 20% gain.
Which, in the long run makes for a much healthier community, even if it makes for less exciting cocktail party stories about how much you made on your house.
Yeah.
We have covered a lot of ground, from the deceptive boom in the condo volume to the very real stagnation in the luxury home market. It's a fascinating picture of a market just taking a deep breath.
It's that breath of fresh air we mentioned at the very beginning.
So before we wrap up, I want to leave you with one final thought. We talked about the 12-month supply of luxury homes. The report calls this market balanced, but here's the question. In a boring market, the biggest risk is often assuming that boring means safe.
That's a very dangerous assumption.
So if you are a seller sitting on a $2.5 million property and you're refusing to adjust your price because you think markets always go up, you are fighting a 12-month backlog of inventory. Every single month you hold that asset, you're paying insurance, taxes, maintenance, opportunity cost. The party is over. The cleanup crew is here. So the question is, are you going to acknowledge that and exit gracefully? Or are you going to keep waiting for a guest who just isn't coming?
That is the million-dollar question.
Yeah, literally something to mull over as you check the ski report. Thanks for joining us on this deep dive into the Mammoth Lakes market. Stay smart, do your homework, and we'll see you next time.